Hello, my name is Guy, I'm back, and I'm the author of the book Business Valuation, but with subtitle Financial Analysis. And today we're going to talk about something very important, very exciting, the working capital requirement, and especially the working capital requirement evolution. Please enjoy! The working capital requirement always the major amount on a managerial balance sheet, because you have to finance your inventories. Customers, they don't pay cash every day, so you have accounts receivable outstanding. Fortunately for the companies, there are also suppliers giving some finance without asking any interest. So the working capital requirement, in fact, is nothing more than the inventory, accounts receivable, other receivables, minus everybody giving finance, giving credit to the company without asking any interest. But especially the evolution of this working capital requirement is very interesting. You know, no financial analysis without a managerial balance sheet. You don't like to work with a managerial balance sheet, you're lost. Impossible. Look at this. Working capital requirement here is on the asset side of the managerial balance sheet. What happens if the working capital requirement is increasing? I will teach you how you have to remember it. Always take the source of financing equal, don't let it change. And then you take your net asset side of your managerial balance sheet, and now you see if my working capital requirement increases, it consumes cash. If the working capital requirement is decreasing, it creates cash. That's a very important one. The problem is this evolution of this working capital requirement can show some hidden things that you don't see just on the figures of the company, and I will tell you what you have to look at. Now, working capital requirements, if you draw it out for your company, they can go like this. This is not good. You're consuming a lot of cash. Something totally different than the other slide. Oh, this is much better. This company is decreasing its working capital requirement. Decreasing means it is creating cash. Now, what is very important, look here, these are months. And this is the year end. So never use only the year end to calculate the working capital requirement. And you see something different or something else also. It's called geometric mean. Now, if you have a dividend that has been paid out to the shareholders, on the balance sheet it could be that the dividend is still there as dividend to be paid. So as it's not financing your inventories, this dividend to be paid, as shareholders will take their money as fast as possible, you deduct it from your working capital requirement and deduct it from your liquidities. So that's very important to do that. Here we have the calculation of the net long-term financing of a company. And you see we have equity, 12.2 million, and we have fixed assets for 3 million, and in the both years it's approximately 9 million net long-term financing. What are you doing? This net long-term financing is a reserve, and it is a reserve to finance the working capital requirement. And here you have the calculation of the working capital requirement, in which we take into account the dividend. So that means the working capital requirement here is 5.5 million and 7.3 million. And that means that the net long-term financing is financing totally this working capital requirement. Or better, or if the net long-term financing for 9 million is financing totally the working capital requirement for 7 million, we have an excess of cash in the treasury of 1.6 million. The problem is, there is a hidden cash here. There could be a hidden cash of about 2 million, and the net treasury is 1.6 and not 3.6 million. That means I could have a dividend of 3.6 instead of 1.6. Why? The reason is this. Look to your working capital requirement calculation. Companies normally, they try to have the minimum of inventory as possible. They try that customers are paying as fast as possible. So the main thing they can influence their working capital requirement with are their trade payables or their suppliers. Now look to this company. If you calculate the number of days that this supplies are outstanding, they are outstanding for 43 days. It's always very important to know what's the normal days these suppliers can be outstanding. And if you would say in this company it's 86 days, that means there's 2 million more suppliers that can be outstanding. But as you're deducting the suppliers from your inventories and your trade receivables, that means that your working capital requirement will become 5.3. And if this becomes 5.3, the net treasury becomes 9 million minus 5.3, and you have here 3.6 million net treasury and not 1.6 million. So very important, don't forget, always recalculate your number of days of suppliers, look to the number of days of suppliers and look whether the working capital requirement is in fact hitting some cash. Thank you very much.